Hey everybody, happy Friday to you. Time for Advanced Option Strategies. My name is Brent Moores, and we do this each week at this time. And today I want to talk to you a little bit about probability cones. Do you guys know what those are, how to read those, how to use that? It's kind of a cool tool on the Thinkorswim desktop software platform. And whether you choose to use it or not, I want you to understand how to use it if you do. And so we'll get to that in just a minute. When I say we'll get to that in just a minute, what I mean is I'm going to go through that, and Connie's going to be helping me out in the chat. We appreciate Connie. She's a good friend, and she's very familiar with what I'm going to be talking about today. So as you have questions, feel free to put those in the chat between Connie and myself. We'll do our best to help you out. You can also follow us on X at Connie Hill CS, at Brent Moores CS, for some additional content throughout the week. Now, let's go through the disclosures here real quick, and then we'll get to the main subject at hand here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It is not a recommendation of any security, chart pattern, or investment strategy. And the paper money software application is provided for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. For the sake of simplicity, the examples in this presentation do not take into consideration commission or other transaction fees, but make sure you consider that. It is an important factor. And all investing involves risk, including risk of loss. Probability analysis results shown are theoretical in nature. We'll be talking about probabilities today quite a bit. And so just realize they're theoretical in nature, not guaranteed, and do not reflect any degree of certainty of an event happening. Short options can be assigned at any time up to expiration, regardless of the in-the money amount, and there's no guarantee in execution of a stop order it's going to be at or near the stop price. Okay, I see some familiar names there in the chat. Glad that you're here. So here's what I want to do. I want to talk about probabilities, probability cones, doing trades with those. We'll give you at least one example trade. And then I also want to possibly hit up another question that somebody, Christopher, asked me regarding open interest. Hopefully we have some time to do that today. If not, we'll definitely get it next week. But I think we'll try and get to that today. So let me bring up the Thinkorswim platform here for you. So what are we doing? Where are we at right now? Market's kind of pulled back a little bit. It was an all-time high earlier today, in fact. So right up there. There's that. When we talk about what a stock is going to do or where a stock may potentially go, let me just bring up one. It doesn't matter. I'll just bring up Amazon. There's different ways to approach it. One way is to use technical analysis. We do that in this class quite often. Some traders don't favor technical analysis, but a lot of traders do. And so for that, we'll look at things like trends and support and resistance and indicators and things like that. And that's certainly one way of approaching the markets. Another way is to do fundamental analysis, look at the market, look at a stock's, earnings or cash flow or margins or things like that. Perfectly fine approach to the market. And there is another way of doing things though, and it's what we call probability analysis. That's using statistics to try and give us where we expect the stock most likely to move. It's not a guarantee, as I mentioned before, but we can just kind of use this statistical measure, looking back at past data, to try and decide where we think the likelihood of the stock going a particular place is there. So, but there's a lot of different ways to look at these statistics. If you just go to the trade tab, this is how we normally do it probably. And you click on options, theoretical, and Greeks here, you'll see there's probability in the money, there's probability of touching, there's probability out of the money. Very often we'll look at either probability out of the money or probability in the money, or sometimes delta. Delta tells us how much that stock is going to move excuse me, let me restate that. Delta is going to tell us how much the option is likely to move in relationship to a $1 move in the stock. Not guaranteed, but it's an estimation. Sometimes we'll use delta as kind of a substitute for probability in the money. This is a probability in the money column. This is a delta column. If you look at the numbers in these two columns, they're not that far off from one another. So very often in this webcast, what we'll do is we'll kind of look at deltas as a means of kind of estimating probability in the money, but you can use the probability in the money measure as well. Neither one is going to be perfect. Neither one knows for certain what the stock is going to do. They're both just different estimates on that. Okay, so these are ways. Now you can also look at things like probability of touching. That's another probability measure that you can use in the market and can possibly help you in your trading. But so that is probably the standard case for what we do in this class is I'm using deltas here, or probabilities in the money here. Sometimes what we'll do is we'll venture over to that Analyze tab and we'll pull up, say, a simulated trade here on whatever stock you're looking at. Let me just throw up something here. Doesn't really matter. Here's a long call. And we look at the risk profile and we can generate probabilities on this as well. And I'm not going to go through it right now because I think 2 weeks ago, we did a session on this page right here. We spent the full time, actually Mike Fairborn, who is subbing for me, spent the whole time basically on this page here. And so I'm not going to spend that much time today on this, but just realize if I want to, I can look here and I can use this to estimate probabilities as well. See, August 8th is the expiration on that. Let me just go here and you can see probabilities up here with your strike prices. So that's another way, yet another way of looking at probabilities here. But there's a way that's not as common, and I was asked about this I think we had a survey and somebody inquired about it, if I'm not mistaken, about probability cones. And by the way, those surveys, when we do have them, we don't have one yet. There may or may not be one in this session, but I always welcome your feedback and ideas for the webcast. But one of them says, hey, how do we use the probability cone here? Okay, so this is what we're talking about. If you go to Analyze tab, go to probability analysis, you're going to get this. This is what we're calling the cone. It looks kind of like this parabola here, or a comet, so to speak. I don't know. That's what it looks like. So this is what I want to talk to you about today. So at least at the beginning of what we're doing here. And there's different parts on this page. There's this upper part, okay, which I'm going to talk about first. There's price slices, which you may be familiar with, by the way, from the risk profile graph, which I already mentioned. This is the same as that, basically. And then there's this table here that we'll discuss as well. So I want to talk about each of these. But let's start basically about reading this cone. Basically what it's saying is, looking out into the future, what is the probability that a particular stock, in this case I have Amazon as just a pure example for us, what are the odds, what are the probabilities of a particular stock going to certain levels in this time? So it starts right here, right at the tip of the cone. That's a 0 right there, cut off a little bit, that's a 0. That means 0 days from now, that means right now. Here's 10 days from now, here's 20 days from now, and so on. You get the picture on that, okay? So this is projecting into the future as we go out to the right on the graph, okay? This is the price of the stock. This is where the current stock of the price is right here, okay? So basically, this is where do we think that stock is going to go? It can potentially go up, it can potentially go down. What's this cone? What's this representation here? I'm going to kind of do a dotted line here, okay? This cone that we see is representing the odds of the stock, again, not a guarantee, but just a probability of the stock going out to a certain range. In this case, a probability range of about 68% roughly. How do we come up with 68%? 68% equals 1 standard deviation. Okay, that's 68%. You can change that to whatever you want, though, and we will change that in a little bit, but that's kind of the starting point. So notice the cone gets wider the further out we get from today. Well, that makes sense, doesn't it? The more time you give a stock to potentially wander up or wander down, the more the chance that it can stray farther from where it currently is. If you go out just a few days, it's probably not going to stray that far. Okay? Now, furthermore, let me just clean this up a little bit. On this page, in addition to days out into the future, it's kind of faint. I don't know if you can see it very well. I don't think I can change the color on it. There's like a little, do you see this right here? There's like a little, it's faint right there. That's an expiration date. That's an options expiration here. Okay. Another options expiration. Sometimes those options expirations may coincide really well with the 10, 20 days out. Sometimes they don't. Okay. Here's one out here. How far is this out? Well, it's a little bit more than 40 days till expiration to get there. All right. So that's kind of a handy tool, because if you're an options trader and you want to use this, you may go, well, look, I'm looking for an option that expires on August 15th or something like that. I can look and see where the cone is on that. Now, it gives you the numbers right here. So let's just do this August 1st one. I think it's kind of easy to see. There's an expiration right there. It says 210, I'm just going to kind of round, and 242. Okay? 210 and 242. What's that saying is, it's saying there's about a 68% chance on this expiration day that Amazon is going to be between 210 and 242. Okay? Between 210 and 242. So that is, and obviously different days, it's going to give you a different number. Now, let's say you want to go not to August 1st, but you want to find a different day that's not an options expiration day and not, well, how do you do that? Well, there's a little kind of like, if you go here, you put your cursor on the page. You see how you put the cursor on? And it can give me the probabilities for any particular price. If you look at this kind of y-axis over here, do you see that? That shows me where I'm pointing at. Okay, so let's say I want to go up to, I don't know, 240. So I'm going to put this right at about 240. And then look at my cursor. Do you see next to my cursor, there's two percentages, kind of in white. One says 72.5, one says 27.5. That's the odds of the stock being above or below, again, theoretical in nature, the odds of the stock being above or below where I'm pointing. Okay, so if I go way out here, there's like 98% chance on August 6th that the stock is going to be below 266. Okay, makes sense. 266 is a ways away. And I can go, down here, and this is saying, 99.99% chance that Amazon is going to be above 195. Is that a guarantee? Nope, that is not a guarantee. And I'm only pointing out the 22nd, which is, we got a weekend. It's early next week there. Okay. So there we go. That's the upper portion of the cone. Let me just show you this. If I change this percentage up here, notice I'm making the probability range wider right up here. I'm going to 90%. What's happening to the cone as I do that? It's widening out. Okay. There's a 91% chance it's going to be within this because I made the cone wider. If I want to reset this, I can go here. This is just represents standard deviations. One standard deviation is around 68%. Two standard deviations around 95%. Those would be kind of more common levels. But we're going to look at customizing this just a little bit in a minute as well. Okay. Now let's do this. Let's look at a stock. Let's mix it up. I'm gonna look at Walmart here. Okay, Walmart is kind of more of a sideways-ish stock. Okay, maybe you agree, maybe you don't. I mean, that's what it's been. I don't know where it's going, But I'd say we probably have some support around here, around the 93.5 level, maybe some more support. Basically, we touched down here intraday. So kind of depends on how you draw the support. Probably this may be a little bit stronger. This may be a little more iffy in terms of the support level, but it is farther away. That's around the 91, 92 level, okay? What about resistance? I've got some lines up here around 100 or so. So anyway, my assumption is this is going to be a little bit more of a neutral stock. And what I want to do is I want to let's look in particular at, say, the 100 level and the 93.5 level. So let's go back here. I'm going to go to my price slices. I'm going to go to 100 and just type that in. And what did we say? We said 93.5, I think. 93.5, enter. Okay, now I did 2 price slices. And it's a little hard to see on the graph. In fact, it's very hard to see on the graph. So you're going to have to kind of trust me on this, maybe. There's a line here at 100. See that faintly right there. And there's a line here at 93 because that's where I put the numbers down here. Now that's fine, but that doesn't really matter. What I want to turn your attention to right now is this right here, this table right here. Notice it says above 100, below 93.5. How did it come up with those numbers? Well, it came up with those numbers because that's where my price slices is. Now, if I wanted to add price slices like we often do at, say, break-even points or something like that, or plus 10%, minus 10% or whatever, you can do that right over here by clicking on that 3-line menu. But for now, I physically entered those lines those levels because that's where I deemed my resistance and support is on the graph. Okay, so let me get out of this. So you can see that, on the table, I can see, hey, for my expiration, what are my odds of this stock going, let's say, I don't know, 35 days out? Odds of this stock going above here or below 93, okay? Or you can pick whatever date you want. This is giving this information at the upper portion of the page down here in a table format. Does it matter? It doesn't matter how you look at it, okay? It doesn't matter how you look at it. You can, if you prefer one, you can do one. If you prefer the other, you can do the other. If I want to go to the 100, above 100 on, say, August 8th, I can go to August 8th, I can put my line right at 100, and it's going to give me, if I could get my mouse, cooperating here, right at 100, it's going to give me the exact same information. Okay, so you can choose how you want to do that, right? So that's the probability table there on this. Now, I'm going to switch. We're going to do a trade here in just a little bit, but I want to switch for a second, and I want to point out something to you. Oftentimes, when we're doing probabilities, like on, for example, a vertical. Let's say we're looking at a short put vertical, okay? And we're doing a short put vertical, and the stock's up here. Here's the stock. And we're bullish on the stock because it's short put vertical, and we're looking at a strike, okay? And I'm just going to, I'll make up prices. It doesn't matter, okay? Our stock's at 53, and I have a strike at, I don't know, 50, okay? Strike's at 50. And we look at that strike, and that strike is a 30 delta, okay? Remember, we can use probability or delta as a probability of being in the money. And we say, it's a 30 delta. That means there's a 30% chance it goes in the money, which is what we do not want to have happen. We want it to stay out of the money. So there's about a 70%, roughly, chance of it being out of the money. And therefore, we have a higher probability trade because there's about a 70% chance it stays out of the money, which is what we want. Okay. Now, technically, the break even isn't exactly going to be at the strike, but you get the point. That's a higher probability trade. And so, but maybe we're considering an iron condor. Let's switch this for a sec to an iron condor, okay? Let's say we're doing an iron condor and we see the stock's at 53, we're looking at that strike at 50, and we have another strike at, we'll go equidistant, 56. Maybe, I don't know if there's really a strike at 56, but we'll say there is. And we say the delta on the call side of that condor is about 30. And so that implies about a 30% chance of it going in the money, which is what we don't want. Now, is this still a high probability trade? No, because there's a 30% chance we fail on the downside if the stock goes down far enough, and there's about a 30% chance we fail on the upside if this is the iron condor. So in this case, in the case of an iron condor, the probabilities that looked good for a short put vertical, because we just had the single leg, well, there's two ways it could work against us. It can go against us on the south side or the north side, so to speak, up or down. So that in that case, with an iron condor, often we may not target the same deltas on that or the same probabilities. Often with an iron condor, what we'll do is we'll say, you know what? I'm going to move these out a little bit wider, okay? And I'm going to make up strikes here. I'm going to go to 48 and, I don't know, 58. And I'm going to find a delta that's around 20 on each side. And that means, yeah, there's about a 20% chance it goes in the money on this side. There's about 20% chance it goes in the money on that side. Is that a high probability trade? And the answer is, yeah, 20 plus 20 is 40. 40% chance of going in the money. That leaves about a 60% chance it's out of the money, which is what we want, okay? So when we're looking at probabilities, they're not always created equal in terms of what you want. Now, let's tie this back to this page, okay? If I'm doing say a short call vertical on Walmart, I'm doing a short call vertical on Walmart, I can look here and I can say, oh, you know, I can look at my probabilities on this and try and generate the probabilities from this. My probability range on this is about 68%, which means it's about 16% chance the stock's below that, and about 16% chance the stock is above that, okay? So that is, all in all, great. That's fine. That means there's about a 68% chance, again, I'm rounding, that it's in between those. You see where we're going with this here right now? Okay. So that's how we're going to tie probabilities on this page to that. So if I were to do say a short call vertical, any strike that I choose, let's say we do a short call that's somewhere kind of right here, that's probably going to be somewhere roughly around a 16 delta, okay? If I were to choose a short put down here, it would be roughly a 16 delta down here as well, okay? That's fine, but that's probably a lower delta than I want on a short put vertical or short call vertical. Remember, on short verticals, and if you've been in this webcast before, or if you've been in one of Connie's webcasts before, when she's talking about short verticals, it's probably going to be pretty unusual that we're picking a short strike on a short vertical that's around a 16 delta. Yes, it's a very high probability trade, but our reward to risk turns out to be very against us in that case. Our reward to risk doesn't turn out to look so good in this case. So short verticals, very often in this class at least, and we differ from this, we stray from this quite often, but just kind of as a rough guideline, short verticals often will do that 30 to 35 delta. That may not be, may not be exact, but it also is very different than what we're seeing here. So if I'm doing a short vertical, I'm probably not going to just pick a strike that's right on the parabola. Now, are we getting closer with an iron condor? Yes, because if we have 16% chance here, 16% chance here, that gives us, well, as we said, about a 68% chance in the middle, which gives us a higher probability trade. The higher the probability trade you have, though, and this is, Harry just asked a question in there. How do we maximize reward to risk on this? The higher the probability of the trade, the reward to risk tends to go down. It gets worse. The lower the probability trade, the better the reward to risk is. So it's a balancing act. Now, Harry asked a very good question, one that I don't have a perfect answer for. But Harry said, is there a calculation that tries to maximize reward to risk? What we typically often do, is we look somewhere around that one standard deviation to do to try and balance that out. Okay, it's not perfect. It's just it's a trade-off between reward to risk and probabilities. But often we'll look at that probability range around there. If our probability range is about 68% or one standard deviation, then you can probably see why often we teach 30 to 35 delta on those short verticals. You see that? Because that means our probabilities are of good things happening are in the kind of 65 to 70 to 70% range. Kind of centers right on that. That's not, I don't believe that is a coincidence. That is kind of why on those short verticals we do that. Okay. So now let's turn to iron condors here. Well, if we do an iron condor, as I mentioned before, and we say, let's say we found something like a 20 delta on the iron condor, 20 delta or 20% in, excuse me, in the money, that still gives us about a 60% chance out of the money. So iron condor, we're doing a short call vertical, we're doing a short put vertical at the same time, or you can leg in at different times on those, that's fine. But point is, when they're both on, that makes it the iron condor, same expiration. And the short call part of the short call vertical, if we do that at a 20 delta, and the short put part of the short put vertical, and do that at the 20 delta, that should kind of more or less accomplish what we're talking about here. So what I'm going to do here is I'm going to switch this around. Don't feel shy. You can play with this probability analysis. And if you forget, what was the default? What's that 68? Forget that 68%. Just click on here and select that one standard deviation. That's going to get you back to that 68%. But I'm going to put this at 60%. Okay. So here's my probability range, 60%. That means if I'm looking at the stock and I find a strike price that's more or less right on the parabola range, then that should accomplish it for my iron condor. Well, let's look at the chart. First step on the chart is, are you kind of neutral-ish? Yeah, I'd say I'm kind of neutral-ish on this. Let's go, the stock's down here. Let me just do my little drawing tool here. Stock's right here, right now, okay? Can't see that. And I'm going to say, we have some resistance around 100. I have some support around 90, we said 93.5, I think. And now that actually is pretty close to where the current price is. Stock's at 95, support at 93. Well, I'm going to go down, and just to be a little safer, I'm going to go down to the lower touch that we had on there. And I'm going to see approximately, at least, what strike price that what price that is. That's around 91 and a half, we'll say, okay? 91 and a half. Let me just jot those down, okay? 91 and a half, 100. Okay. So we can use both technical analysis and probability analysis together if you like. Now, there are traders out there that don't care about the technical analysis. They don't want to do technical analysis. And in that case, maybe they just use the probability, whether you're doing it on the option chain or doing it on the risk profile page or the probability analysis page, the probability cone. Doesn't matter how you're doing it. If you come up with that, you could just do that and totally ignore the chart, but we're not going to do that. We're going to say, I want a neutral-ish stock, which we kind of established. It's kind of been going sideways. Assumption is it's going to stay there. I want to establish my resistance and my support, and I want my wings of my iron condor to be outside of those strikes. Okay, so outside of the 100 strike, outside of the 91 and a half strike. So that's what we're going to do here. Now, there's one other consideration I would mention, and that is earnings. I was looking through some different stocks, some more sideways looking stocks, and a lot of them have earnings that are coming up. Walmart, I already checked, has earnings on 8/21, so I'd certainly want to do an expiration before then, but you can do any expiration you want. One of the nice things about this cone is it gives you it just by the expiration date. If I wanted to do something, this would be very unusually short term, but it's possible. You can do an iron condor out a week. Your wings are going to be in pretty tight there, aren't you? Okay. In fact, your wings are going to be inside of where our support and our resistance levels are. As we go out a little bit farther, then we're getting about there. 99.74, I'm going to call that's 100, and this is about 91. That fits the bill for our support and resistance levels that we calculated. Therefore, this gives me the probabilities. I know that the probabilities from this, the estimated probabilities, are about 60% in here, roughly 20% here, roughly 20% here. That's going to be how I'm going to construct that iron condor on this. Okay, so let's do it. Now that was August 8th. I'm going to go to Add Simulated Trades. I'm going to go to August 8th. And we said 100 strike on the call. I'm going to sell that. 102 strike. I'm just going to do a two wide here on this, on the long call. On the put side, we said 91 and a half. So we'll go to 91. 91 and a half was a support. I'm going to sell the 91, and I'm going to buy the 89. Now I'm going to go to risk profile, and that's what it looks like. Okay. Now I can go and let me just adjust this because our expiration is there. Let me set my slices to break even. There. Now, we said we were looking for about a 60% chance in here, about a 20% here, about a 20% here. Now, it's slightly different. Keep in mind that the short strike is at 100 and at 91, which would probably push this closer to the 60 level if I were to move those in there. Also, in fact, we can look. I don't know how this is going to look. We can go 90. We said 91 here. Put that as a price slice. And we can say 100 here, put that as a price slice. And it's showing right around 60%, okay? See how that works? Those are connected to one another. You don't have to use the probability cone to do it, but that's just kind of a simple way of looking out as you look out into the future, different expiration dates, where those strike prices need to be in that. Okay, so there's the trade. Now, pros and cons of this trade. There are pros and cons to iron condors. Let me start with the con. The con is the reward to risk ratio is not going to be great on it. Okay, that's the kind of the bad side on this. The reward to risk ratio is not going to be great. The pro is it's a higher probability trade, and we can only lose to one side at a time, right? So if the stock goes way up against us, remember this is a neutral trade. If the stock goes way up against us, the put side of the equation is actually doing pretty good. Let me go to the trade tab. Now, if you want to do this, you can add it this way. You can go to spread, iron condor, and you can just kind of click on something and you can tweak it. We said we were going to do 89 and 91. We said we were going to do 100 and 102. 100, 102. If I click on confirm and send, I'm not going to send it quite yet, but you can see, hey, I'm potentially risking a lot more than my max loss. That's why I'm going to put exits on this, because I do not want to ever realize that max loss. Now, the max loss it's real, and it is certainly possible that we can achieve that, okay? But we're going to do our best when we look at this trade. If the stock starts to go against us too much, we're probably going to look to get out. Now, let's say the stock goes against us. Let's say the stock goes all the way down to, 87. That represents max loss at expiration. But before expiration, that's the purple line, that is not representing max loss, okay? Same thing on here. If the stock goes way up to, 105 or something, that's not a good situation. We'll surely be losing money on the trade, but probably not anywhere near max loss. But what I'm going to say is, look, if the stock just goes against us far enough, I want to get out of this trades, okay? So let's do this. Let's say, look, if we break in resistance, I'm going to get out at, 101. If we're breaking it on this side, I'm going to get out at, if it breaks below 91, 101, 91, I'm just going to look to exit out of this, okay? So I'm just going to click on first triggers sequential. I'm going to right click. I'm going to create an opposite order, and I'm going to say to get out of this, I'm going to make this market good till canceled. I'm going to click on the gear, and I'm going to say I want to get out of this if Walmart marks either less than 91 or if Walmart marks greater than 101. Okay, that's just to try to help us in case things go a long ways against us there. Click on save. I'm going to make this, what did I just do? Confirm and send. I'm going to put this in our, I don't have groups out right now. That would be in our Iron Condor group. Okay, make sure you read the red stuff on there. Okay, make sure you read the red stuff on there. Red lines on there. Remember, stop losses don't guarantee us to get out at any particular price in particular. And short options can be assigned early. Now, there's a lot of other trades we could do, and I'm not going to do another full trade here, but let me just show you some example, kind of more neutral-ish type stocks. You can look at Apple, has earnings coming up at the end of July. Dow Chemical, kind of more of a neutral-ish stock, has earnings on July 24th. KMI, kind of more of a neutral-ish stock. Earnings is passed, so you're kind of clear of earnings for a while. USB is something that maybe this is a little bit more bullish. Had the bounce, we're past earnings on that. But you could try this out on this. Now, part of the purpose of today was to try to show you different probability measures and introduce you, if you weren't familiar, to the probability analysis tool, okay? And there we go. And yes, so questions in the chat. John says, you submitted to close the Iron Condor. Yes, I did. I put that trade in. Okay. Here's my trade to enter the trade. Here's my trade to close it. Hasn't filled yet. We'll see if that fills. I could tweak this a little bit to see if we can get this filled here. Let me just see if I can get this filled. I don't want to go down too much. Yeah, the price moved on me just a little bit. I'm going to confirm and send that. Okay, so we just sent that Iron Condor. We did submit that closing order on the Iron Condor right there at the same time. Okay, now John also said, a lot of different ways to get this. I showed you different ways, and so you don't have to do all these different pieces of the puzzle that I did to get to this. Remember, if you want to find support and resistance, all you need to do is look at the chart, look here, identify your support and resistance. If you want to go the traditional way we do it in this class, you could just look at the delta and look for, say, for example, a 20 delta or something like that on each side, and do it that way as an alternative way. So, but a lot of traders, there may be other circumstances other than doing this trade that you decide you want to look at the probability chart and see where the possibilities of that stock are there, okay? Absolutely. You can close out, by the way. Often on these Iron Condors, we will close them out one at a time. In fact, I would invite you to join me for my Managing an Options Portfolio class on Wednesdays at noon Eastern Time, where we manage a lot of these trades, and you'll see that often we do close out one side at a time. Now, I want to address one more question here that I got in the before the session, and it was this. It was looking at puts, looking at let me pull up open interest here. Looking at open interest on this. What do you do in this case here? We got this way big outlier here in terms of open interest, okay, on open interest. And what does that mean? Somebody traded 190 puts. It wasn't today, or the volume would be showing here. 190 puts on this, on ADI. Do they know something that we don't know? Well, maybe, but I would hesitate to just take that as something that you necessarily go trade. But one way you can do is, let's just see when those came on. So I'm going to right click on this. I'm just going to copy the symbol of the option trade. I'm going to pull up the chart of that. Okay, let me just paste that symbol in there. And here's the option price. We don't usually look at option price charts, but look, here's where the volume spiked on this. That's where that huge, massive trade came in on 528. So I don't know. Remember, on any trade, there's a buyer and a seller. Now, the other end of the trade may be a market maker who's doing it, but somebody is buying and somebody is selling the contracts. I don't know if this was a long put or a short put when it was initiated. Okay. So, and Frankie just typed in, we don't know if they bought them or sold them. If they made a bet to this point, at least, if they made a trade, if they were speculating that this is a long put, if they bought the put, speculating that the stock was going to go down a lot, so far they've been big losers on this trade. If, on the other hand, they were short sellers, so far at least, it is good. It's, things have gone pretty well. But it's been on for a little while here on this. So I don't know whether they bought or sold the contract, so it's hard for me to say. But I guess what my take is, I wouldn't necessarily go chasing trades here based on what other people do. It's a good thought. One other way to do it is to look at the trade flash, and you can look down here if the trade occurred today, or you can look at today's option statistics. If the trade did occur today, that's not what I want. Go to today's option statistics, and you can see how many were traded near the bid price or how many were traded near the ask price? Although we can't tell technically whether it was a bid or a buy or a sell, if the trade has come in at a price close to the ask price, often we'll assume it is a buy transaction, a long transaction. If it's come in near the bid price, we can often assume that it's more of a sell transaction, but there's no guarantees on that. And often it'll come, somewhere in the middle, and then you just don't know. All right. So you can see is it traded near the bid, traded near the ask, and there's more information on that right there. Okay. So that's how you can tell. But because this occurred several weeks ago or a couple weeks ago, probably can't tell. Now, I am out of my time, folks. And let me just think. I think one last question. Myron said, can we do this, all our trades on indexes? Yeah, you can use indexes for those too. Absolutely. You sure can, Myron. Good question. So, in fact, we have a specific class for trading index options. Everybody, thank you for joining me today. Have a wonderful rest of the day. Coming up at the top of the hour, we've got Market Movers. Check that out. Everybody, see you same time next week. Bye-bye.